What's up, guys? Today we were talking 5 dividend growth stocks that I think that I can hold on to forever and never need to worry about. Actually, I'm going to talk about 7 because there's a little bit of an overlapping area and something I discussed here on the channel. It's defining what a dividend growth stock is and a dividend stock and a growth stock is. It's really, really hard to do. And at first I want to avoid it at all costs. But, after some education, after hearing from you guys, I see that there really is a place for what we call this dividend growth stock. So first and foremost, I want to tell you what my criteria was for this, because I know that it's going to be up to the individual to decide what they think is a dividend growth stock. For the sake of this video, I called a dividend growth stock a stock that is paying a dividend less than 2%. And I know there's some right there on the cusp. For example, Home Depot is just over 2%, and I'll talk about Home Depot in this video. But for me, I cut it off under 2%. So they have to be paying a dividend from 0 to 1.99. And also they have to be consistently beating the S&P 500 over the last 5 to 10 years for that growth part of the dividend growth. I'm just going to touch upon some simple metrics that I look at as far as the growth and the dividend, so I don't need to bore you with numbers. I'll try and get through each one of them pretty quickly, and then I'd love to get your feedback at the end of the video. And I did do a poll on my community tab on YouTube. There were a couple of awesome dividend growth stocks that people did mention that I want to kind of like give an honorary mention to that didn't necessarily make my top 5. Those included SCI, UNH, Lockheed Martin, and a few others. You can head over to the community tab and see some others that people put. I value your opinions. Like I said, they just didn't make my top 5 this time. The first 2 that I'm going to mention are pretty cliche when it comes to dividend growth, and that's going to be Apple and Microsoft. And although it's cliche and I know it's kind of like a given, it would be hard to talk about a dividend growth portfolio if I did not include Apple and Microsoft. They are staples in the growth community. They pay a very low dividend, which is awesome. Their dividend growth has been great over time. So I want to look at the metrics and just compare those 2. But if you're starting a dividend growth portfolio, unless you have something really against Apple or really against Microsoft, it'd be a hard argument to give somebody that you have a dividend growth portfolio that does not include Apple and Microsoft, in my opinion. I'm going to dive into Seeking Alpha, which is the site that I'm using for my initial data when I'm looking at data on a stock. We'll talk about Apple Inc. first, ticker AAPL. We look, first the growth part of this, guys. Year to date, 56.52 they're up. That's incredible. They did just have a big jump we see after they announced their stock split, but still, even without that stock split, amazing growth. Last 52 weeks, 126% growth. 5 years, 296% growth. 10 years, I'm chuckling. It's insane how much this company grows. Now, as far as the PE, people would consider this overvalued, but I feel like in this industry, in this tech industry, everything seems to have a higher PE ratio than, say, the S&P 500, which is like right at about 20, 21. So they are valued a little bit higher. So we can see the dividend yield right now, 0.71, which was getting you $3.28. With that stock split coming at the end of the month, that is going to change a little bit. And guys, they're approaching a $2 trillion market cap. Guys, it's just incredible. If we come down and we look at their revenue, these are going to be their estimated revenues. They've been yo-yoing a little bit, I think, with the economy and what's going on. But if we look at their general trend, their revenues are going to be up. If we hit their dividend information quickly, their dividend growth, 8 years they've been growing. 5-year CAGR, which is awesome at over 10%. Payout ratio, 25, super low. They're going to be able to increase that dividend with no problem whatsoever. And then if we take a look at this momentum tab that I love so much, this gives a price return versus the S&P 500. We can see that it's been steadily above the S&P 500 for the last 10 years, we'll say. The total return versus the S&P 500, also well above the S&P 500. This right here, guys, is a quintessential dividend growth stock. And one of the awesome things about Apple and the things that I love is that we try and look forward and see what they're going to produce next, but we really don't know. And anything we could think of seems crazy, or anything they talk about seems crazy, but everything they've ever produced when they first announced it seemed really crazy to us. And they have streams of income all over the place, from their phones to their Macs, iPads, accessories, earbuds. It goes on and on and on, all the way down to their iCloud services and Apple Music and things like that. They are well diversified. They are going to continue to produce some of the best products in this industry. and they are going to be around for at least my lifetime. If we do the same with Microsoft, MSFT, year to date 32, year 55.9, 5 years 344, 10 years 756. So not as much as Apple, but they have other great qualities. So right here we can see their PE ratio, a little less, 32.46. Their dividend yield is also a little bit higher at 0.98, which right now is going to get you about $2.04 per share with the way things are working out. So a little less growth, but a little more dividend. So we see that little bit of give and take. They've also been paying and growing a dividend for longer than Apple at 16 years, pretty much an identical CAGR of 10.45, a little bit higher ratio, which is going to come with a little bit higher dividend payment, and that's to be expected. If we look at the momentum graph, once again, the same as Apple, the price return and the total return, it's well above the S&P 500. So like I said, Apple and Microsoft, they're kind of the elephant in the room. They have to be talked about. Now let's move on to some other things that might not be as obvious to you. They definitely weren't as obvious to me. The next dividend growth stock that I'm putting in my portfolio is Nike. Guys, Nike is a worldwide brand. I know that this year they took a little bit of a hit, but they have, just like I said, their worldwide presence and the amount of brands that they have under their portfolio is just incredible to me. And I'm very, very confident that it is going to grow over my lifetime as well as continue to pay a dividend to its investors. They are well versed in anything that's athletic, from apparel to shoes to as well as other equipment. So we got bags, socks, like any type of sporting equipment, bats, you name it. If it has to do with sports, Nike definitely has their hands in it. Like I said, this year with what's going on, sports are down. So I would expect them to be down as well, but they still actually have a little bit of growth this year, even with what's going on. I was surprised to learn that they also have Converse. They own Converse, so your Chuck Taylors and all of your Converse shoes as well. Hurley, they own that brand, so that's under their apparel as well. So there's some things. They have the Jordan line, the Air Jordans. Like I said, Nike, they're doing something that is worldwide. They still have room to grow into emerging markets, and I think that sports is always going to be prevalent, not only right here in the United States, but in the rest of the world. And when sports come back to the United States, I think we'll see Nike rebound to exactly where they are. They're super innovative. We know right now, I'm a runner, so I keep seeing what they're doing with their running shoes in the running shoe space. They entered the CrossFit space and just knocked Reebok right out of there. They're doing things in their research and development, which is really, really promising for me. It'd be really easy for a company with such a huge global base to sit back and say, we're good, keep revenues kind of flat and not worry about it so much. But they continue to want to go higher and be a premier brand in this type of space, which is why I'm confident in them for my portfolio. And like I said, even with what's going on right now, guys, year to date, they're still up 5%. Look at this huge dip. They got killed when this virus came around and when sports went out, but they recovered nicely, and now they're continuing back on that upward trend. Over the last year, 31%, and that's with that huge dip. We could imagine where they'd be as well as other companies if that didn't happen, but that's just part of the game. We like to just see that they rebounded nicely. Over the last 5 years, 86%, 10 years, a 500% growth. Now, their PE ratio is astronomical. I'm not going to lie. I think a lot of people would say currently they're overvalued right now at 45, and it might just be some of that bounce back, and things might come back down and level out, but we see. It's going to be an upward trend for Nike regardless of what their valuation is right now, and I think everything will catch up. Their dividend yield right now forward is going 0.92%, which is going to get you about $1 every single year, which is awesome with this growth as well. We see their revenue climb. Like I said, they took a hit, but if we look forward, their estimations are going to be right back up to where they need to be, and I think everything's going to be just fine for Nike. They've been paying and growing their dividend now for 18 years. Their CAGR is well above even Microsoft and Apple at 12.6. Their payout ratio is a little bit high. That's okay, 41.85, and that's just because their revenues and their profits right now are a little bit low. That payout ratio is going to balance itself out. I generally like to keep a payout ratio under 75%, so 41.85 is just fine for me. And like I said, we see that yield of 0.92, which is going to get you $1 this year. If we look at their momentum chart, we see that it pretty much follows the S&P 500 because it is selling all these consumer brands and things like that, so it is going to track a lot of the S&P, but we see it at a greater percentage. So it's just going to grow a little bit quicker than the S&P, but follow a similar trend. And I think the fact that it follows a similar trend, it never really dips below, makes it even more of a safe dividend growth stock for me. It kind of gives me more confidence that at least at worst case scenario, it's going to track the S&P 500, which is my bread and butter. The next company is Lowe's, guys. I'll talk about the numbers real quick and then how I feel about it. Year to date, up 28.87. We see once again dip and recovery, 64.91. 5-year 114. You guys can look up all these numbers. Their PE ratio right there at the S&P 500, 21.18. Their dividend yield 1.43, so getting a little bit higher, not that crazy. Their revenues are going up and up on an annual basis. They're coming in with great earnings per share, even above what people estimate. They are a dividend king, been raising their dividends for 56 years. An insane CAGR as far as I'm concerned at 20.23. Payout ratio is super low at 30. Right now, like I said, they are an awesome dividend growth stock. And this is kind of where my criteria gets a little bit foggy, because if I just go by under 2%, right now they're at 1.43. But if we look at Home Depot's growth is just as good, if not better, than Lowe's. Their PE ratio, a little bit higher, not that crazy, and their yield right there over 2.14. And like I think a lot of people would say, if we look at their dividend, 11 years, a great CAGR, it's pretty much a coin flip between Lowe's and Home Depot. Now, to be honest, I put Lowe's first, and I didn't start with Home Depot and go to Lowe's. One, because of that criteria I set, but I think also I'm a little bit more on the future growth of Lowe's. I think right now we're in a world where do-it-yourself projects are on the up and up. I know if I have to do something, I get on YouTube, I'm always trying to do something myself first. And I think that Lowe's has a little bit more of a friendly feel, a little bit more of a do-it-yourself kind of feel. I know my wife feels more comfortable going into Lowe's. I know that if I have a question, I like to go to Lowe's. They're a little bit friendlier, where Home Depot is a little bit more for those contractors and for those people that are in and out and kind of know what they're doing. That's, like I said, my opinion. And I think with the do-it-yourself trend that's going to be moving forward, I think there's more potential growth than Lowe's over Home Depot. I think Home Depot is just as safe because contracting is not going to go away. You can't buy lumber and sheetrock on Amazon yet, maybe one day. But if you do, it'll probably be sourced through one of those companies anyway. So like I said, my pick is Lowe's, but it's a coin flip between Lowe's and Home Depot. I don't think you'd have a trouble with dividend growth with either of those. I own Home Depot in my dividend portfolio because it's over 2%. So actually I own both Lowe's and Home Depot. They just sit in two different portfolios for me. And the last one I want to talk about, guys, is MasterCard Incorporated, ticker symbol MA. And once again, guys, I'm going to go say it right off the bat. It is a coin flip with Visa. But if we look at just the numbers real quick, we have 9, 22, 233, and a 10-year growth of almost 1,400. They have a P ratio at 48.85. So once again, in this type of industry, we're going to see some inflated evaluations. That's okay for me. It is high. I'm not going to say it's not high, but it's not something I'm necessarily worried about. They have a dividend yield at 0.49, which is going to get you about $1.60 per share. Their annual revenue is just going and going and going. We see a little bit maybe with the consumer purchasing down. Their estimates are a little bit, but they're going to bounce back. They're going to be just fine. MasterCard right now, they've been growing their dividend for 9 years. CAGR 25%. Payout ratio is super low. They're going to be able to continue to grow their dividend as well. And they crushed the growth of the S&P 500. Other fun facts that I didn't really understand about MasterCard and Visa for that matter until I did my research. Right now, they are in about 210 countries and territories, and they deal with over 150 different currencies. Now, I know Visa and MasterCard as credit cards. I always thought that they made their money from the interest that we paid on credit cards, and that is not true. They make their money by the bank that issues that card, okay? There's something called the gross dollar value that these banks are going to use on this card, and that's how Visa and MasterCard make its money. Every time there's a transaction with your credit card, there's really 4 parties involved. There is the person that owns the card, and their bank. And then there's the merchant, the person that you pay, and their bank as well. All Visa and MasterCard they are a middleman between those transactions, between us, the consumer, and our bank, and the merchant and their bank. They don't make money on the fees that go on between them, the bank that issues us the card. So right now, if I have a Chase Visa card, Right now, Chase gave Visa a ton of money to allow me to own that card. And then I go out and then Chase is going to make some money on the different fees and the interest while I own the card. But I used to say to myself, I don't want to own Visa, MasterCard because I hate debt. I hate credit cards, this, that, and the other thing. They don't make money off of our debt necessarily. Maybe indirectly they do, but they're making money off of the banks, not the people that spend money on the cards. And full transparency, guys, I own both Visa and MasterCard. It's more than a corn flip to me. I think you can kind of diversify and protect yourself and own both. So I'll show you Visa real quick. 4%, 13.33, 5 years, 164. We have a 10-year of just under 1,000. P ratio of 39.2. They are a bigger company than MasterCard, so some people like Visa because they're a little bit safer. Their yield right now, 0.61, which is going to get you about $1.20. We see the almost identical revenue path of MasterCard, so I don't think there's any differences there between them. They've been growing their dividend for 11 years. CAGR 20, payout ratio super low as well, 24. And like I said, if we look at their momentum chart, it's going to be identical to that of MasterCard, just crushing the S&P 500. So that's pretty much what my updated dividend portfolio is looking like. We got Apple, Microsoft, Nike, Lowe's, Visa, MasterCard, and then that VGT that I've talked about in past videos. Let me know in the comments below, did I miss one that's very, very obvious that should be a major player like this? And give me your thoughts on Visa, MasterCard, Home Depot, Lowe's, etc. And is Nike supposed to be in this conversation or not? I would love to have your feedback. Until I see you guys on the next one, stay positive, work really, really hard. Always, please be kind to other people. Hope you have yourself an amazing day and an even better tomorrow.